All right. Hello. How's everybody? Welcome back to the lecture on financial statements. So, in our last class, we had a very uh, full and in-depth discussion about the income statement. And I made a very clear distinction in the goal or the purposes of both income statement and a balance sheet, respectively. Now, I said that the income statement is the goal of the income statement is actually the describing the process to profit, right? The process to profit, leading to profit, is called operating activity. Now, the the goal or the conclusion of the income statement, right? It could be profit or loss, but I told you we don't need to make distinction that way. We can profit can be either positive or negative, right? Negative profit is, of course, loss. So we can simply call it positive or negative profit. Now, also, as opposed to income statement, the goal of the balance sheet is to describe the capital structure. And I briefly mentioned that the capital structure is the composition of equity and debt in the total assets. Equity and the composition of equity and debt in making up the total assets, right? So let me actually go back to Excel and use the example to show you what I mean by that. So if you see here, if you look at the balance sheet, right, I broke it up into asset side and liability side. Now, in the normally they can put it, vertically, top to bottom, right? But then if you do it that way, then it's very difficult to see in a screen. You cannot see the whole thing in a single computer screen unless the computer screen is vertically long. Now, so it's easier to break it up into two segments. One segment, the left-hand side, which is the asset side, and the right-hand side, which is the liabilities and equity side. Now, I've been also telling you that the liabilities and equity are not necessarily a different thing from assets, right? I've been telling you they are two sides of the same coin. Now, let's first define what asset is. Assets can be defined on at least like three levels. Well, on the first level, it is defined as what you own, right? Probably in Accounting 101, the first thing they will tell you is that the assets are what you own and the liabilities are what you owe. Now, that definition needs to be expanded a little more, because to put it simply in terms of owning something or owing something, right? That is not entirely wrong, but it is incomplete in a way, right? So I'm going to come back to that later. But that is the first level of definition of assets, right? On the second level, assets equal to liabilities and equity. Now that's quite obvious from this balance sheet, right? The left-hand side, total of the left-hand side is the total assets, and the total of the right-hand side is total liabilities and equity. They must balance out. They must balance out. That's why it's called balance sheet. Now, then think about it. If they balance out, that means whatever is in the asset side actually came from the liabilities and equity side, right? In other words, liabilities and equities are basically the source of the funds or the source of the capital, right? They raise this $9.855 million through equity and debt, right? And then all of that capital raised is used to purchase all of this. In other words, the left-hand side, the asset side shows basically the asset side is showing you how that $9.88 million capital is held, and then in what form they are held, right? Um, it can be held in the form of cash. It can be held in the form of marketable securities, uh, and so on, right? And it can be held in the form of accounts receivable. Some of it is held in the form of plant and equipment. Some of it is held in the form of building and land, and so on, right? Now, and the right-hand side, the liabilities and equity side, are basically showing where they came from, where that $9.85 million dollars came from. And it can come from only, basically one of the two sources or the combination of these two sources, equity and debt, right? Equity is the owner's capital, right? That came from owners mean shareholders of the company, right? Uh, so in this example, out of this 9.85 million, $4 million came from the shareholders, right? And and the rest, 5.75 million came from the long-term debt holders or creditors or bond holders, right? Lenders, in other words. They all mean the same thing. Debt holders, bond holders, creditors, and lenders, they all mean the same thing. Of course, bond holders are a specific category of the lenders, right, or creditors. But basically, that's basically, where this 9.85 million came from. Now, so the second level of definition of assets is assets are equal to liabilities and equity, right? So that's called accounting equation, and that sums up the idea behind the balance sheet, right? The so it completes the picture of the two sides of the coin, right? Two sides of the coin. If one side is the asset, the other side of the coin is the liabilities and equity. Meaning that means the assets came from liabilities and equity, and also the coin two sides of the coin analogy. You remember from income statement? Do you remember there was another analogy of two sides of the same coin? What was that? That was the revenue and cost of goods sold. Isn't it right? The CGS, cost of goods sold, is the cost side of the revenue. Remember that? So that's why sometimes CGS is also called cost of revenue. That's the cost side of the revenue. Revenue is actually the price side of the cost, right? The price side of the cost, or the sales side of the cost. So anyway, so if that is the second level of definition of assets, what's the third level of definition? The third level of definition is that the assets must have income generating capabilities, right? That means, assets are there to generate income for the owners of the company, right? Now, think about it. The assets like plant and equipment. Why do you have plant and equipment, right? What is that for? The plant and equipment exist to produce something, right? Produce the finished goods or the merchandise, and to generate income from sale of those, outputs of production, right? So the sole reason for being, right? The sole reason for existence of the assets is to generate income. If it has no power to generate income, they have zero value as the asset, or they are called non-performing assets, right? They are doing nothing, right? Okay, so then let's take a look at the structure of the balance sheet. First of all, looking at the asset side, you will see that it's listed from the current asset, and then the first part is current assets, and the second part is non-current assets. Now they go by so many different names. First of all, it's quite obvious. Let's start with the non-current assets because it is quite obvious. Non-current assets are also called real assets or physical assets, fixed assets, right? And long-term assets. Now, why? Plant and equipment are physical, right? Whatever is physical is real. And then they are also fixed. Look at the building and land, plant and equipment. They are all fixed, right? And they last long term. They last very long, right? At least 20 years or more. So they are also called long-term assets. Okay, and the reason and the fact that this company has plant and equipment indicates something that's quite obvious. What is that? This company is a manufacturing business, isn't it right? Because plant and equipment is a very typical aspect of manufacturing, right? Service industries, retail industries don't have any plant and equipment, right? And the plant equipment here, you might say, fax machine is an equipment. Isn't fax machine or cash register, isn't that? No, not that type of equipment. The equipment mentioned here is what is called physical capital or capital item, right? Capital asset. Capital means means of production, right? Means of production. Not money capital, right? But physical capital, right? Um, so having, plant and equipment, right? That's the most salient feature of manufacturing. So we can easily understand this is a manufacturing business. And let's assume it's Dell, a computer manufacturer, right? Uh, so when they assume that they are starting up from zero, right? Time zero, right? Of course, this is a hypothetical example. And when they start out at time zero, right, of course, they didn't have any plant. They probably started building, computers, on a small scale uh, in Michael Dell's father's garage, right? Like, Bill Gates started building, computers. Uh, Steve Jobs started out like that in a small, shack or father's garage, but let's say um, they were uh, that's really really at the beginning, starting even in the form of corporation, right? But let's say they got spotted by a venture capital. So capital offered to invest money. So when they offer to invest $4 million, right? Of course, for uh, this capital investment, right, by the venture capital, they would ask for stocks in return, right? So let's say they issue 1 million stocks, 1 million shares, right, or maybe 5 million, right, and then uh, arbitrarily at this point, because uh, at this point the company is not listed in the stock market, right? It's just privately held company, right? And since $4 million were invested by this venture capital, they will uh, give 4 million shares to the venture capital, and then what will be the uh, as a token of ownership, 4 million shares will be given to the venture capital, and uh, that would make the price per share exactly $1. Wouldn't that be? Because $4 million divided by 4 million shares. Of course, Michael Dell and other, the original founding members would also uh, take part in this, and probably uh, they will chip in like some money into this, and they will give themselves some shares if they chip in like $50,000, right? Uh, the total number of shares, total equity originally, uh, I mean, if they chip in like $500,000, total original equity will be $4.5 million, and they will issue like 4.5 million shares, and uh, uh, it will be $1 per share, right? Of course, we will just assume that there was originally $4 million in paid in equity, paid in, right? Paid in capital. Now, anyway, and then the rest of it was raised by debt, right? 5.855 million was raised. What what would they need that capital for, right? What would they need that money for in the first place? They will need that money for uh, to acquire plant and equipment and building and land. Think about it, right? So initially, what they raised, if they raised, this much capital, that will mostly be going to uh, acquiring plant and equipment and building and land. The the current fixed assets or physical assets or real assets, right? And I'm going to come back to depreciation later, but let's take a look. Because at time zero, right, at the beginning of year one, they won't have any depreciation at that point. But when you look at the balance sheet, you will have to look at the balance sheet at time zero and at time one. In other words, at the beginning of the period and at the end of the period, right? So one year later, right? Then there will be depreciation 1 year later, right? This one is so look at this as if this is the result at the end of the year, right? But anyway, during the course of the year, what would happen? The operating activity would happen, right? So remember, the operating activity is reflected in the income statement, right? And in the income statement is the result of the operating activity at the end of the operating period. Now, the operating period is generally a month, quarter, or year, but generally quarterly, right? Because companies calculate their earnings and report that earnings data on quarterly basis. Okay, of course, for internal purpose, right? For internal managerial purpose, they collect and compile data, and they constantly calculate their the earnings bi-monthly, right? Bi-monthly data collection, but that's not the data they would release to the public, right? Or I mean, the company that is selling stocks in the stock market are required, right? It's mandatory to release their earnings data, right, on quarterly basis, right? So if the company is privately held, right, they have no such obligation. But anyway, for their own internal purpose, they also follow that cycle. They will, basically close the book at the end of each quarter, and then they update their data and update their earnings performance, right? So anyway, so if they if they need to, if it costs $6 million for plant and equipment and $3.5 million for building and land, right? The total current assets would be 9.5. But at the end of the year, right, the plant and equipment will depreciate because all equipment, right, machinery and equipment will wear and tear with usage, right? And as they wear and tear, they go down in value, right? That's by definition what depreciation means, but that's not only that. We're going to come back to that later. So in year one, so obviously, when the plant and equipment wear and tear, then it will go down in value. But also, not only that, but also the production capacity would go down, right? Because of wear and tear, right? it is no longer new machine, new equipment, right? Obviously, the productivity would go down, right? And when the productivity goes down, of course, it should be reflected in decreased value. You cannot, it's like, you cannot value the 2-year-old car at the same price as the new car. Why? Of course, there has been wear and tear. You've been, there'll be signs of wear and tear, right? Um, Obviously, the in terms of you may have taken very good care of the car, even if you have taken a very good care of the car, um, and it has very low mileage, right? Once it has rolled out of the dealership, right? The value goes down drastically, right? Uh, Now that is actually, a different story because depreciation of the business asset uh, uh, goes by a totally artificial schedule, right? So it's not the actual wear and tear or actual resale value of the asset. It's just, depreciation goes by totally artificial schedule. Okay. Now, so then that explains what the fixed assets are, and or physical or real assets, long-term assets are. Now let's go to the current assets. Current assets are also called liquid assets or short-term assets, right? Uh, and some of it is also called financial assets, such as marketable securities, right? Promissory notes. Now, so the current means actually, liquid, right? Some people say automatically just by uh, like by rote memory, they say, oh, current means present. Yes, current means present, but in this context, current actually means running, right? Because now in French, French for current is courant. Courant means running. I mean, in several other languages, it would be pretty much, it would sound similar, right? Probably in Spanish it is like correndo or whatever. Italian it would be similar. But what does that mean? Now think about it. The fluid is running, right? Stream is running, and the running stream is called what? Current. Isn't it right? So that means cash, liquid assets are uh, liquid assets are basically current assets. And if you think about it, uh, ca- uh, liquid assets can easily change hands. It can run from one hand to another, right? Uh, so first of all the current assets are listed in the order of liquidity. So the cash and cash equivalent. Cash is the most liquid asset, so it is put on top. And then marketable securities. Marketable securities means stocks and bonds. They can be easily converted into cash because it's you can sell if you have stocks or bonds. You can easily sell. Uh, you can easily sell them immediately, right? It's readily there is a market that's readily available. Now, so the next question is then, some people, often think that these are stocks and bonds of the uh, this company. No, no, it's not the stocks and bonds of this company. This company, these are the stocks and bonds of other companies that this company is holding, right? Um, why? Because uh, they will limit the cash holding to the minimum. Why? Um, cash doesn't earn any interest. If you're holding cash holding means what? The cash you have in your bank account, in your checking account. Suppose uh, nobody keeps cash. I mean, the companies don't keep cash in their pocket. I mean, whose pocket, right? It's not carried by people, right? If company is holding cash, it will be in the bank, and then the money in the bank, in the checking account, doesn't earn any interest. And even if it earns any, even if it's in the savings account, it earns very, very low interest these days. So uh, uh, so they will keep cash holding to just uh, only the necessary minimum, right? And then hold the rest of it in other forms of financial assets uh, that would maximize that would give you the highest return possible. So that's why as they are holding in marketable securities. Now, cash equivalents are basically a very short-term uh, financial instruments that has very low fluctuation in value. So they are like if you're holding $1,000, right? Although it's not giving you any return, but uh, except the influence of the inflation, right? Uh, $1,000 will still be $1,000, right? It doesn't drop in value, right? Except for the inflation, right? But if you hold $1,000 in stocks, it may go up or it may go down, right? It may drastically go down. So uh, uh, this is the reason that you have some of them, you hold some of those cash equivalents, uh, which can be easily turned into cash, right? Sold and turned into cash easily. Also, it can be uh, unlike stocks and bonds, it won't fluctuate that much in the value, right? Now, promissory notes are basically a credit sale, right? Promissory note, and we will need to come back to the discussion of promissory notes later. But basically, it's an IOU by one company to another company, right? Now, when I say IOU, it sounds like you can easily write an IOU, but because promissory note is literally what it means. Okay, uh, it's a promise to pay. But then think about it. If you write an IOU, who's gonna take it, right? Who's gonna lend you money? I mean, the bank. Will the bank take your IOU. So in other words, personal IOU is totally useless and meaningless in B2B, business to business transaction, right? In personal, if you write a personal IOU, maybe your parents will take it or your family members will take it, right? Uh, or a very good friend will take it. But when they take that IOU, uh, it's not because they expect to get it back. They are almost giving away the money because you're a family member or you're a very close friend, right? Uh, but in B2B, the promissory notes are very important instrument, right? So before getting into an example of promissory note, let me define what liquidity means. I said current assets are listed in the order of liquidity. So what is liquidity? Um, it can be defined on three levels as well, right? Just like the assets, it can be defined on three levels. On the very basic level, um, it is defined as how easily you can convert any asset into cash, right? How easily you can convert any asset into cash. On the second level, it means cash flow, right? But think about it. Cash flow, if your company has high liquidity, what does that mean? The company has a lot of liquid assets that can easily uh, be sold and convert into cash, right? So then the company will have high cash flow. The company won't be as stripped of any cash. The company won't have any cash flow problem. They will always have good cash flow if they have highly liquid assets, right? Makes sense. So on the second level, it means cash flow, and on the third level, and this third level is macroeconomic level. On macroeconomic level, liquidity means money supply, right? And why? Now let's think about it. If all the companies throughout the economy has uh, uh, a lot of cash flow, right? All the companies have, very good cash flow. Uh, what does that mean on macroeconomic level? That means there's a lot of money supply throughout the economy, right? There's a lot of money supply throughout the economy. So it can be defined on three levels, right? So liquidity means money supply on macroeconomic level. Okay. So coming back to the promissory notes. Uh, so let me uh, let me also combine it with the accounts receivable. Now, accounts receivable is basically also credit sale. And I said promissory notes are credit sale and accounts receivable are credit sale. So how are they different? Look, they are both credit sales, but they are different in terms of who initiated that credit sale, right? Promissory notes are credit sale initiated by the buyer, right? In B2B, business to business transaction. And the accounts receivable is the credit sale initiated by the seller, right? And the promissory note, so let's think of it this way. Um, So if you are Dell, right, if you're a computer manufacturer, right, your major client would be something like some companies like retailer like Best Buy, consumer electronics retailer like Best Buy. So let's say Dell makes, and we used this example before, right, in income statement. Dell makes the computer, let's say a particular model, right, and they sell it for $500. Remember, we also assumed in the previous example that the direct cost or the production cost per unit or average variable cost is $300, right? But when they sell it for 500, right? So um, if Best Buy purchases 1,000 units of that model, right? The total sales revenue for Dell would be $500,000, right? Now, um, the Best Buy has like uh, four options when it comes to the payment methods, right? One obvious, method is cash. They can pay $500,000 in cash. Two, they can pay by check, right? $500,000 check. Uh, Three, they can use credit cards. Four, they can use promissory notes. Now, what's the difference? Uh, in business to business, no, the payment method, most preferred payment method by the buyer is the promissory note, and the least preferred method is the cash. Okay, from the buyer's perspective. And then from the seller's perspective, it's exactly the opposite. Most preferred by the seller is the cash. Least preferred by the seller is the promissory note. Why? Now let's think about it. If buyer pays with cash, what does that mean? Buyer doesn't have that $500,000 anymore, right? Once you make the payment, it's gone. Now, from the seller's perspective, if they receive cash, they can use it immediately for whatever or they can put it into a bank and earn at least the bank interest rate, prevailing market rate, right? Now, so the seller doesn't, if possible, they prefer to receive cash. Uh, they don't want to, if possible, they want to avoid receiving promissory notes. Why? Because promissory notes uh, uh, are generally promissory notes generally come with the maturity. They have like 30 days, 60 days, theoretically up to 270 days. Um, but in reality, most likely 60 days. Now, what does 60-day maturity mean to both seller and buyer? Now, the buyer is the issuer of the promissory note, and from the buyer's perspective, if they pay with 60-day promissory note, then they can defer payment for 60 days, and they can put this money into something like a stock. And then if the stock market is good, they can probably earn 10% or 20% even over 60 days, right? On the other hand, since the seller is hesitant, the seller would be very reluctant to receive promissory note, but seller accepts promissory notes most of the times because they want to push their sale. Think about it. If they say cash only, right, their sale will be limited, right? But they accept it, but they are less happy, clearly, to receive promissory note than cash, right? Now, so to facilitate the acceptance of cash, then the uh, buyer or the issuer of the promissory note will uh, uh, pay interest on it, right? Something like prevailing market interest rate, or something slightly less than that, to compensate for uh, the foregone interest that the seller could have earned, right? But then think about it. If the interest you have to pay on the promissory note is only 2%, right? But what you can earn from the financial market by putting that money into the financial market is 10%. Then isn't this already more than self-financing? In other words, the promissory note more than pays for itself. Isn't it right? Um, you can put $500,000 into the financial market and earn 10%, but you pay 2% interest on this promissory note. So uh, even you after paying for that interest, you still have 8% left, right? So this is why they use a promissory note, right? Now, second, accounts receivable. The accounts receivable by semantics is quite obvious. The semantics is telling you that it is uh, uh, something you still have to receive, right? The payment you still have to receive. So that means it's a credit sale. But then, as I said, it is seller initiated. What does that mean? Now, between the in business to business, right? There is a manufacturer and retailer. In this situation, retailer is the buyer, manufacturer is the seller. Now, also between manufacturers and the suppliers, for example, manufacturers are buying the raw material, right? Parts and components from the supplier, right? And then let's say even a Dell, computer manufacturers don't make everything themselves, right? They outsource some, parts, like, mouse or, keyboard or, whatever the parts and components. Um, uh, Also think about it, memory chips, right? Dell doesn't make memory chip. They buy from Intel or Hewlett Packard or from other uh, chip makers, Hyundai, Hynix, or Samsung, right? So the but chip memory chips are a different example because those companies that make memory chips are also very, 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 very large companies. They are uh, they are in a position to flex muscle against computer manufacturers like Dell. But suppose um, think about a small, very small manufacturer like a mouse manufacturer, right? These are small manufacturers, right? And then Dell is a very big uh, buyer, client to them. So usually, Dell would be in a position to flex muscle against, the small mouse manufacturer. And mouse manufacturer would have to be very careful not to upset the big manufacturer like Dell, because if they upset, they uh, um, rub it against, Dell, then Dell would they will lose their business, right? A very big business for a purchase from like 2-year purchase contract from Dell would mean the viability of, to this small manufacturer. So think about it. Usually, these suppliers of parts and components are uh, generally, they're not selling it, order by order, right? In other words, Dell can, computer manufacturers like Dell don't purchase, uh, uh, like, by, uh, like shopping from a department store, right? You can go to a department store or a shopping mall and you can choose from whatever. But think about it. There's a technical specification that should be satisfied, right? Quality also, that should be satisfied. So, a manufacturer like Dell would look for outsource, look for a small manufacturer of components, and if they find um, one that satisfies all those technical criteria and quality criteria, then they sign a uh, long-term supplier contract for something like 2 years or 5 years. So during those 5 years, they order they get the mouse supplied by that particular company. And from this company's perspective, right, such a long-term supplier contract, um, would be a big deal, right? Because uh, the company will won't have to worry about sale month to month, day to day, right? They will have a steady stream of demand, right? They will have a steady stream of orders, right? For the next 5 years or something like that. So if Dell, and then usually if this is the case, then they use just-in-time inventory management. What that means is Dell doesn't have to order every time, order the mouse every time. So suppose Dell has a production plan for 1,000 units, and then their current inventory level of mouse is low. They have only 100 mouse in their inventory. Then they will have to replenish. I mean, 900 units of mouse or mice are needed. Then they don't have to place an order every time this happens, right? Uh, these two uh, plants have their computers online, right? So that when the when they have, Dell has new production plan and their existing inventory uh, is low, right? Below the required level, that information is automatically transmitted and shows up. And since they are online, it shows up on the supplier's screen, and then they will automatically ship 1,000 uh, mice, right, to Dell. This is called just-in-time inventory. Why? Well, usually, think about it. You might think Dell would stockpile. They will stock up the mouse or other parts, in a huge quantity, right? In huge volume in their warehouse. No, they don't want to do that. Why? Uh, you don't want to stockpile huge inventory of parts and components because warehousing is not for free. It carries cost. First of all, if you have uh, uh, a huge, stockpile of raw material, right? Uh, uh, there is, you have to insure, right? You have to have an insurance for that because what if there's a fire, flood, or something to the warehouse, right? You don't want to risk that, so you have insurance. But there's a that's you have you have to pay insurance premium. That's called uh, inventory carrying cost, right? Second, uh, warehousing isn't for free. For example, you might wonder if you have your own warehouse, why isn't that for free? Well, look, uh, first of all, building a warehouse, right? That is a cost to your company, right? Of course, you would need to have a very minimal scale warehouse at least, but you don't need uh, uh, unnecessarily a big warehouse because what if you have nothing to store there, right? Then the warehouse is being idle, right? So generally they don't want to. And if keep a warehouse that is idling. But if you have one, then you should use it to make money, right? If it is idling, then you can at least rent it out and make money on it, right? But um, it's altogether better not to have a big warehouse and instead just simply rent a warehouse. But renting a warehouse is still a cost, right? Um, so if if you don't have to store a huge volume of raw material, then uh, uh, if you don't want to do that, then you can if basically the supplier of the raw material, they will need that inventory anyway because they are the supplier of that inventory, and you can just have them warehouse it and have them ship it to you, warehouse them in their own warehouse and have them ship it to you whenever it's necessary, right? Then you don't have to incur inventory carrying cost or warehousing cost, right? So this is why it's called just-in-time inventory, right? And then when in just-in-time inventory, when they ship you, right? When they ship you the uh, 1,000 mice uh, without any particular purchase order, right? Because your production schedule is also known to them, and so they just ship the parts and components in time for your production uh, schedule, right? Production to start. Uh, and then what does when they ship it, then um, they will have a claim. I mean, if each mouse is $20, then that would be $20,000, right? But they ship it without any particular purchase order. Um, then what do they uh, have to show for that claim, right? What do they have to show? Mhm. For that claim for $20,000. Think about it. Um, Invoice is the physical counterpart of that concept of accounts receivable. Because when we say accounts receivable, you just say it very easily. But accounts receivable is a concept, right? It's just an idea, right? It's not a physical. There's no accounts receivable is not a physical thing. It's a concept. What is the physical counterpart to that concept? It's the invoice, right? You have to uh, clearly see that because in promissory note is both an idea and a physical proof, right? It's a physical paper, right, that shows that the buyer owes money to the seller. But in case of accounts receivable, that word by itself is only a concept, right? So then, what is the physical thing that represents the accounts receivable? Invoice. Okay. All right. So time's up. Uh, I'll have to. We'll have to call it a day, and we're gonna continue in the next class. Okay. All righty. So that's the end of the video.